All right, let's talk about some financing secrets, how to fund your first deal. So now that you know how to find the market, analyze a property, and confirm that it's in the cash flow zone, the next question then becomes, how do I actually fund the deal? And here's the good news. There are more ways to finance real estate than most people realize. In this lesson, I'm going to walk you through and show you exactly how to think about leverage, the different funding options available across North America, and how to structure financing that works in your favor, so not against you, right? So part one of this module, let's go over why leverage is the key to growth. And it really comes down to real estate is one of the only places or businesses where banks will lend you up to 80% of the money to buy a cash flowing asset. So think about that. You bring a portion of the capital and the bank finances not just the rest, but the majority of the whole thing. And your tenant effectively pays pretty much the loan and all the expenses for you. That's the power of leverage. Leveraging people and money. So used correctly, leverage accelerates your wealth. That's the big kicker in real estate. Used poorly and it will destroy you, and it'll certainly magnify your risk. So our job as investors is to use smart leverage, where the rent comfortably covers the debt, the expenses, and still leaves a bit of profit for us. So there are three main ways to finance an investment property. Number one is traditional financing, traditional banks, right, or credit unions. So this usually requires 20 to 25% down payment for rental real estate. It's best for single family homes and small multifamily properties. Usually it has the lowest interest rate, and it'll have a reasonably long amortization period or loan period, 25 to 30-year periods. And they are great when you have a strong income and clean credit. This is what I'm going for. I'm trying to get conventional finance most of the time. So pro tip with this though is that if you want, you really got to make sure you yourself or a mortgage broker shop multiple lenders before you commit to anything. Because even a 0.25% difference can make a really big difference in your income statement, and it'll save you thousands over time. The next way to finance is private or alternative lenders, and it's usually used when you don't fit the main bank box, right? Maybe you're self-employed, maybe you're growing really fast, or you have too many properties with mortgages. Not always, but often they're going to have a higher interest rate, and usually they'll have a shorter term associated. So they're great for like bridge loans or refinance options or fix and flip strategies. And I would think of private money as a tool, not so much of a permanent solution, but it can help you move quickly and reposition and then refinance later with the bank. So you might use it short term until you get stabilized and then try and get some conventional financing going. For your first deal, I'd try and get conventional financing right away though. Just keep it simple. The last one I'll touch on, which I don't think is your good starting point, but it's definitely an important one for your journey as you have more and more properties, is creative financing or partnership-based financing. So things like number one would be joint ventures. You would partner with someone and one person brings the deal and takes care of all the management and all of the stuff that we're talking about here, so overseeing the expertise side, and another person brings the capital and the money and maybe co-signs or qualifies for the mortgage. Another option would be of creative financing would be seller financing. So I make an offer to buy a house and I actually ask the seller to provide the mortgage to me or provide the financing to me. So that's basically the seller acts like the bank would and puts a mortgage on they go on the title as the mortgage holder, right? So these are all different options. Another one would be like an RRSP mortgage. These are more advanced creative financing tools or strategies. And you can have people lend you money from their RSP as a secured loan, right? So it's another amazing option. Each of these can help you get into deals even when you don't have all the capital yourselves. But you always got to structure all this type of loan stuff with clarity and win-win alignments and win-win agreements, and making sure a real estate lawyer is involved to verify all the contracts. Doing deals without contracts in real estate is a huge no-no. So I want to just jump back into our original real estate analyzer and budget. So in the first module, we talked about growth rates and making sure that you're in a market that actually has growth that you understand and is sustainable, population growth, job growth, income growth, and ultimately real estate price growths. Then we did like the basic cash flow zone statement. So we put in all our numbers and we're like, okay, it looks good. We find out that we're cash flow positive, right? So we get down here and we're going to make $2,300 a year or $198 a month. That looks great, right? $200 a month, and it's going to be a 4% cash flow, or 3.9% cash flow each year on cash on against my investment. So that looks good. Now I want to show you the power of leverage, though. So if we go down further here to section D, which is our appreciation forecast. So I'm going to click on that. If we have a market, so this we've put in 5% here. If we're in a market that is growing at 5%, we've established that this is a growing market at about 5%. 5% of $210,000, if that's my purchase price, is $10,500. And then the following year, it'll be another 5%, so that's another $11,000. And then the next year, it's going to be another $11,000, and it's slowly getting higher because it's 5% on a bigger and bigger amount each year. So you can kind of see end of the year prices are going up. So by the time I get to year 8, I'm at $310,000 expected value of the property. Now, that's important. It's good to get this 5% growth on the property, but we haven't actually put $210,000 down. So the power of leverage comes here. So I'm going to skip over to section E, which is the total return forecast. Here, you can see that I've actually only put, my initial investment was only $60,000. So when a property goes up $10,500, I don't make 5%. I'm actually making $10,000 divided by my initial investment. So I'm actually making 17.4% if you divide those two numbers. That is the power of leverage. So by putting less down, it increases my total return on my money. Now, if you put less down, my cash flow is going to go lower, and my mortgage pay down is also going to go lower because I have less down, less debt to pay off. But if you add them all up, you're going to get a total return of 28%, right? And even if you take out the appreciation, so this is where I was talking about like making sure I have a good return even when I'm not including my bonus, which is the appreciation. So if all goes well and my market's growing at 5%, I'm going to make 17%. But even if there's no appreciation, I'm still going to be making, let's add these up, 10.61%, not including appreciation. That is healthy. So that looks good to me. And I'm going to do this whole analysis before I even make an offer on this property. This all looks good. So each year you're going to see, so now I've just made $16,000. So the following year, I'm going to add this number and this number together, and I get my equity starting for the next year. So my equity has gone up now, my amount of money I have in the deal. So I'm actually becoming less leveraged every year. You can see next year I'll have 95, then it's 114, but you'll notice that the other part is that even though my total return each year is actually increasing, my actual percentage return is getting worse each year. It's going down. Why? It's because I'm becoming less and less leveraged, right? Each year, there's less leverage in the deal, which means I have more equity in the deal, which means that the total I'm making, my total return is being divided by my equity that I have in the deal. So it's actually getting, it's appearing to be lower, right? Well, it's not appearing to be low, it actually is lower. So at some point, in order to keep my return high, I'm going to have to refinance. So I'm happy with a 28% return. That's amazing. So probably around year 5 or 6, I'm probably going to refinance the property. So by that point, I would have about $156,000 in the deal. So I might pull out, I mean, how much would I pull out? I mean, if the deal is worth, let's see, year 6, the deal is going to be worth $268,000. So if I do equals 268, 1, 2, 3, and I want to keep 25% down payment, so I would only need to keep $67,000 in the deal in year 6, which means I could take the total, I could take this amount, $67,000, and minus what I have. So I could get the bank to write me a check here for $90,000, and I would still have 25% down in the deal, and my leverage would get balanced, and then my return on investment, my return on equity would go up. So this is getting into a little bit more of the high level, I suppose, how to manage like the long-term financing of a property. But this is important to know because I could have 100% of the property paid down and I have $280,000 of equity, but now I'm going to have no leverage on my appreciation, which means if the market goes up 5%, I'm going to make 5%. And my cash flow is going to go way up. And that's kind of how the math works on this stuff. So the more debt I have down, the lower my cash flow is going to be, but the higher my appreciation is going to be. So this is the balance point of how to assess risk. Okay. So in terms of conventional financing, I want to talk a little bit more about some of the key ratios that your banks and brokers are going to be looking at. They're going to be looking at your debt service coverage ratio. That's the first one you need to know. So debt service coverage ratio, it measures if rent covers debt, right? Lenders want to see at least a 1-to-1 or 1-to-3 coverage. The next one is the loan to value. So that is the loan as a percentage of the property's value. So we've kind of talked about that with rental real estate. Usually you'll see something like 25% equity and 75% debt. And that's also going to have the highest reasonable leverage like we just talked about. So they're also going to be checking your credit score. And yeah, they're going to want to review your debt to income ratio. So if you're an employee, this is going to be easier for you. If you're self-employed, it's going to be more challenging for you and you might not qualify or you might need someone to co-sign. These are all challenges if you're not having T4 income or if you have other debt that's getting in the way of these ratios. So yeah, I mean, this and another caveat to this is that none of this applies to you when you start getting into larger multifamily deals where they stop looking at you as an individual and they start looking at the property itself as its own self-sustaining business, right? With multifamily, like if you have a 50-plex, I'm not going to be able to pay the mortgage for a 50-plex personally, right? They're going to look at the building itself to cover that mortgage. And they have a whole different criteria when you get into commercial banking. That'd be like commercial lending almost. Now, for how I think about financing strategy, when I look at a property, I start with one simple goal. I'm really looking to find the cheapest, most stable money without having to sacrifice cash flow, right? Sometimes that means locking in a fixed rate mortgage. Other times it means taking short-term private financing to close a great deal, and then I refinance the property later once it's stable. So like I might do a vendor finance if they'll deal with me or they want to do it for a year or two, and then I'll take and get a conventional loan from a bank afterwards. Once I've already owned the property and I've shown a history of making my payments, right? The principles of all this stuff never really change. It's all about income and making sure you can cover your costs, right? Cover your loan, right? With the income from the property, which is the rent. That's why you got to make sure you're staying at market rents, right? The financing has to fit the deal, not the other way around. As you grow, you're going to start to run out of personal borrowing room. And that's when partnerships come in, right? That's where I'm at that stage of the journey where it's time where I'm doing bigger deals to take the pressure off of me because I have a lot of personal mortgages. They're all healthy, but it starts getting more complicated, right? And I spoke a little bit about joint ventures. You know, in the early days, joint ventures are great. Someone like me might bring the financing or bring the expertise and bring the deal management and all that stuff, and somebody else co-signs a loan and brings some money. And that's pretty much, that's the partnership, right? And then you just have like some kind of a split, and you can have a joint venture agreement that's signed, formalized, and registered on the title of the property. And this is really how a lot of people scale in their business with financing and just scale from 1 to 3 to 5 properties, right? So for your financing checklist, before closing any deals, make sure you've checked these boxes. Pre-qualify for your lender, right? Get a pre-qualification. Compare at least 3 different financing options with conventional banks. Ideally, your mortgage broker can help you with that. Stress test your deals using a sheet like this, the one that I've been using here, so you can do some sensitivity analysis. Try increasing the interest rate by 1% and see what happens to the financing, see what happens to the property's returns, see if it still cash flows. Having other backup financing options is really helpful. You know, I've had to revert to that many times in my life. And Yeah, to recap on this video, smart leverage is how you grow faster without overextending yourself. Make sure you match your financing to your deal strategy and use tools like the analyzer that I just showed you to test what if scenarios before you make offers and before you buy properties. In the next module, we're going to talk about building your power team, basically building a team. So having other working professionals in real estate like mortgage brokers, realtors, property managers, accountants who make all of this work behind the scenes, right? They do all this work behind the scenes. So before you watch the next training, start by and I guess an action step for you is start by building a sophisticated investor binder. I didn't talk about it in the video, but like there is a PDF attached here, which is a step-by-step on what to prepare for your banker or for your mortgage broker to make you look like a sophisticated investor that knows what they're doing, right? That first impression and how you present to a bank makes a difference. They will notice it. And it's something that very few people do, your sophisticated investor binder. So follow it step by step. It's in the attachments, and there's a bunch of other attachments as well about lending and financing that you can keep as resources and download and print. So I will see you in the next video.